Hello, everybody. Come on in the room. Guess what? It is session 5 time. Session 5 of what? Our 3-day financial workshop. And we have been talking all about money, money, money. Yes, we've been talking about seeing it. We've been talking about getting it. We've been talking about tracking it. And we've been talking about growing it. Y'all, I don't want to hold up time too much longer because today we are going to be talking about how do we grow our money. And so just a couple of housekeeping for us, couple of points for housekeeping. This session is interactive. And so as the presenter is sending forth and giving information, and if you have questions, please, please, please type your comments, your questions in the chat. And at the end of the presentation, our presenter will be able to answer your questions live. Okay, and so yes, we truly want to appreciate everyone who is watching now live, and if you're watching the replay. And so today, again, in session 5, we're going to be talking about growing our money. And the session name is increasing and investing your money with ease. And y'all, we're about to hear it on today. It is coming. Our presentation is coming to us by Chantay Moore. She is the director of the Native American Financial Literacy Service. Chantay, come on in the room. We are so excited to have you, and you just take it away.
Hi, Ramona. Thank you so much. And welcome everyone for joining today's session, Investing and Increasing Your Money with Ease. My name is Chantay Moore. I'm a certified financial educator and investment advisor representative. And as I mentioned, I own this company where we teach financial literacy workshops. So I'm so happy to be a part of this series on increasing wealth, especially for small business owners. So if you could advance the next slide, please. So before we get started, I always start with a disclaimer because we're talking about a really big topic that's literally a 2-hour presentation. Doing my best to condense it down as much as possible. But just want you to know whether you're joining live or if you're watching the replay, some of the things that I share might change because we're talking about a couple of things regarding investing, regarding taxes. Laws are constantly changing. Also know that this is strictly for educational purposes. I'm not here to solicit any type of services. I can't offer any type of financial advice or anything like that. And then lastly, you won't learn everything today. Because of the timing, I'm going to touch very high level on a lot of topics, and I'm going to breeze through a lot of them, but my slides will be available for those who would like a copy, and I'll share some additional resources for anyone who would like to get in touch with me. So if you could advance the next slide. So I wanted to just take a step back before getting into investing and growing our money with ease because I truly believe, we're all busy folks. And unless this is what you do every single day, all day, I highly, highly encourage you, especially as a small business owner, to start building and working with a team of financial professionals. So myself, I'm actually a licensed financial professional. I've been in the financial services industry for over 16 years. I have all type of licenses to help with insurance and investment and everything you could imagine I can help my clients with. And I want to encourage you to understand that it's always in your best interest to engage professionals when you're making these financial decisions. Don't try to do it on your own. I always encourage you to work with professionals, number one, because we can give you objective advice. We can see the bigger picture. We can really help you lay out that roadmap. Another thing is that when you work with a financial professional, especially when it comes to investments, we also give you access to the best financial products and services that are available. So, yes, I recognize there are a lot of places that you can go on your own and open up investment accounts and things of that nature. But the best of the best products, trust me, are offered through having a financial professional. And then lastly, if something goes wrong, because it's inevitable, it can, unfortunately, when we're trying to build relationships and money gets involved, you also want to make sure that you have recourse for anyone that you choose to work with. And having a licensed financial professional helping you with some of these things that I'm going to talk about today will be an extra way to keep yourself, protect your money, and also to have a way to hold that professional accountable. You want to have a way to where if you need to, file a lawsuit or make a complaint, that you can do so. And you can't do that with people who aren't professionals. And at the end of the day, like I said, when it comes to investing and growing money, anyone in my world, this is what we do every day, all day. We have hundreds and probably thousands of clients, depending on who you're working with. Why don't you lean on somebody's professional experience? Just like you have your business. I know that you're an expert in your business. Lean on professionals who are experts in our line of education and the things that we do. So go ahead and advance to the next slide, please. Because I want to just kind of ground this presentation with really thinking about, okay, what options are out there? Because it's a very loaded question to say, what should I invest in? What should I pick? What's the hot stock of the day? Again, I can't answer that for you in this capacity, but what I can do is take a moment to educate you about the different type of investments. And if you can go to the next slide, please. So I always want to take a step back to just look at what do we have available? Because at the end of the day, your goal should be to grow your money, right? Like that's what this whole series is about, is growing your money. Unfortunately, a lot of people put their money in places that just do not grow. And listed here, really anything associated to the bank, any bank accounts, checking, savings, money market accounts, CDs, uh, a lot of those treasury bills, bonds, a lot of people say, oh, let me get a savings bond, and they think it grows. It actually doesn't. A lot of these accounts earn maybe 1% interest, and I'm talking about maybe 1.5, maybe 2%. A lot of these accounts earn little to no interest. On average, a savings account at a bank will give you 0.09% interest, which means for every $100 you have invested or saved, 9 cents is your return. I don't think that's a smart money a smart money decision. I want to give you tips so that you can be smart and make financial strategic decisions with your money. I always tell people that these type of accounts are just usually keeping up with inflation. And actually, these accounts really aren't keeping up with inflation. Inflation's been a big topic the past couple months because the cost of living has increased. We've seen 7% inflation, which means everything costs more. So if your savings aren't even keeping up with inflation, you're actually losing money. So let's go to the next slide. So here, I want to just kind of briefly give you an overview of what investments actually will grow. Now, mind you, these are just the tools of what will go inside any type of account that you would open. So most folks are familiar with stocks, where that's where you have ownership within the company. Bonds are actually, there's so many types. There's government bonds, corporate bonds, junk bonds. They're basically a debt that's issued by an organization or a company, and they issue that debt because that's something that they have to repay. So you, the investor, would buy a bond with expectations of getting repaid money and interest later on in the future. Then you have mutual funds, exchange traded funds. These type of investments are where they take pools of investors money together, and then they'll go out and buy portfolios and baskets of securities and stocks and things of that nature. UITs, these are actually my favorite type of investments right now. Unit investment trust. Again, very same concept, where you take a pool of investments of investors' monies. They buy into a fixed portfolio of stock that they hold for a period of time. I equivalent this, I call UITs the Uber of the financial industry, just because you're getting from a point A to a point B. Then you also have index and variable products. These are available from insurance companies, so life insurance products, one of which I'll actually talk about today. Annuities, these are excellent ways to grow your money. And then if you're a little risk taker, a lot of folks can get into options trading, commodities trading, forex trading. Those are very risky ways to invest money, but obviously they can also have a very good payoff on the other end as well. So when working with a financial professional, we'll help you to figure out which of these investments make sense for you. How do we combine them? How much should we put into stocks? How much should we put into EFTs or whatever it is? So again, these are the things that you really want to look at to grow your money, to beat inflation, to at least get 4%, at minimum 4% interest or higher. Hopefully you're getting double digit returns when you have a good portfolio of these investments together combined. If you could move on to the next slide, please. So One thing I always tell folks is, because the question always comes in, well, what investment should I pick, Shantae? Well, it really depends on a couple factors. Number one, what is your risk tolerance? A lot of times we don't think about my willingness, your willingness to lose money, to grow money. There's always a balance. I have some folks they'll come and tell me, well, Shantae, I want to make the most money possible, but take on no risk. That's not an option. Like there's no way that you can make the most return and not have some type of level of risk involved in that. That's two completely different strategies. So I always want folks to think about, what, no matter where you're starting out with, no matter how much money you have saved that you do want to invest, always think about how much of that am I okay with potentially losing? Because we can't guarantee anything with the stock market. There's always a potential chance where you could actually lose money. And you want to think, what is that number? What would keep me up at night? If I lost X amount of dollars, what's going to make me pick up the phone and call my financial advisor freaking out? You should have that as a guideline, because once you understand your level of risk, then you know what portfolio of investments you can actually put together. Always know your comfort zone. When I work with my clients, I'm like, look, we have reasonable expectations. This is the minimum, this is hopefully the maximum or higher, but we have reasonable expectations and we have a comfort zone so that no matter what happens, even if the market's down, even if I'm taking some type of a loss, I was that was acceptable for me. It was in my comfort zone because I know that's involved in this game when you're playing with investing in the stock market. If you can go to the next slide, please. So today, I also want to just have folks think about when you're investing your money. I always tell folks it should be for a goal, it should be for a purpose, it should be for a need in the future, whether that's like retirement or maybe to start another business or to purchase a house or to, do something for your children or grandchildren, whatever that goal is. That's something that you want to and talk to with your financial advisor, because we would then understand a time frame to reach that goal. If you have a 1 year goal versus a 20-year goal, I'm going to give you completely different portfolios of investments to reach those goals, just because the time frame is different. Here on the screen I have examples of a short time frame being anywhere generally from 1 to 5 years, and these are all my perspective again from my experience of what I put together. For someone who's investing for a midterm goal, that might be 6 to 9 years away, and then a long-term goal is 10 years or longer. We have time to work toward accumulating that goal. The general rule of thumb is that the shorter the time frame you need to save more money. You need to invest money, because a lot of people think, oh well, my money will just double or triple overnight, and that's not the case. You have to give it time. And you should also understand that if you have a shorter time frame, you can't expect a big, massive increase in your investments. It's just not how it works. We call it the time value of money, and you have to start right away. And have some patience and just be consistent with saving, because building wealth, it truly takes time. And if you're thinking you're going to get rich overnight, it won't happen. This is a game of patience, a game of sacrifice. So we can go to the next slide, please. So now that we kind of just have a basis for investing in that foundation, I do want to spend the time to talk about different investment, more in particular retirement accounts that are available to you as an entrepreneur. I'm really talking to entrepreneurs here, small business owners, because we're unique. I'm an entrepreneur myself. So we don't have like a corporation and their benefits package to take care of us. You have to create your own retirement accounts. You have to go out and find your own insurance benefits. So I want to go through a couple of options, as you might evolve as an entrepreneur, about what's available to you and then also to your employees. So we go to the next slide. We're going to first start with a traditional IRA. So an IRA stands for individual retirement account. This is an investment account that you would create for retirement. Now, why would somebody want this account? Number one, it gives you tax deferred growth. That's a huge benefit, meaning when you're putting your money in and it's growing and growing and growing on top of each other, you're not paying taxes on that growth. That's a huge thing, because your money can just keep being reinvested. It can keep growing. However, with this retirement account and pretty much most of these accounts that I'll talk about today, the IRS, our favorite uncle, the Internal Revenue Service, says Chantay, you can't keep putting this money away and not paying taxes. At some point, you need to pay taxes. So their general rule of thumb is at age 59 and a half, that's when the IRS says you can pull that money out in retirement. You won't have to pay the 10% penalty any longer. But whatever you pull out, though, is taxed at that time. Because remember, while you were investing it, while it was growing, you never paid taxes. It's when you actually pull it out later in retirement where you have to pay your taxes. So that matters because let's say you establish a traditional IRA and you're 20 years old, maybe you're a 20-year-old entrepreneur. We don't know what tax rates will be 40 years from now when you're in your 60s. Tax rates go up and down, unfortunately, depending on who's the president, who's managing our laws and government right now. So that's something to keep in mind. You're essentially writing a blank check to the IRS because we don't know what tax rates will be in the future. But don't let that deter you because another benefit of having a traditional IRA is that the contributions that you put into it are potentially can be written off as well on your personal income tax return. So let's go on to the next slide. I want to talk about one of my favorite investment accounts, which is a Roth IRA. I believe pretty much any person can establish a Roth IRA. Again, it's for retirement, it's for investing for money in the future for retirement. But the reason why people like this particular account is because you can put money in it and it won't grow. I mean, sorry, it will grow and you won't have to pay any taxes while it's growing. So you get that tax deferred growth. But the number one benefit is that when you pull this money out in retirement, you do not pay any taxes. It's a huge, huge benefit. So it's a way for you to grow money for retirement that can be completely tax free to the future for you. You're able to convert a traditional IRA into a Roth IRA. You'll basically take a tax hit now, and then any monies left over will grow tax free into the future. So it's a huge benefit. I love our Roth IRAs because it gives you so many exceptions as well to where if you wanted to pull money out early, let's say you're not 59 and a half, you could actually pull money out early for education purposes, or if you were disabled, or if you were actually a first time home buyer. So let's go to the next slide and talk about a SEP IRA. So this is actually for a lot of folks when you're in business and you might start having employees. This is a simplified employee pension plan. This is actually a plan where only where the employees and the employer can contribute to the plan. So the employer has to, if you establish this for your business, every employee, and once they meet minimum qualifications, every employee has to have a SEP IRA, and you have to contribute to all of the employees' SEP IRA equally, proportionally. It's based on their compensation, but you have to provide this and contribute to all of your employees. This is also a tax deductible expense for the business. So it's a way to incentivize you to provide a retirement account for your employees, but also to where you get a tax deduction on your business income tax returns. And employees can also contribute. It's not required, but they are able to. But let's say you establish this SEP IRA for your business, the employees can also contribute to this SEP IRA, or they can go out and establish their own traditional IRA and Roth IRA and continue to save for their retirement as well. So if we could go to the next slide, I'm just going to finish through a couple of these counts and wrap up. The next IRA is a simple IRA. This is a savings incentive match plan for employees. This would be ideal for businesses who have no more than 100 employees. You really want to have a well-established business that has steady income. The employer and employee contributes to this plan. The employer can match up to 3% of what an employee puts into their account, or they can do a flat 2% on every single employee. Employees can also defer up to $14,000 of their own compensation for this plan. And the nice thing, again, is that business owners can deduct all of these contributions. So when you become a business owner, one of the number one things you should be paying attention to that you probably do care about is taxes. So this is again is another way to incentivize you to provide benefits to your employees and get a tax deduction for the business. Next slide, please. So I want to talk about a solo 401k. We typically hear about a 401k when we have a big corporation, but what if you're the only employee in your business and you have significant income? You're making pretty great money. You might get to a point where you make so much money, it'll disqualify you from a lot of other investment accounts. That's where a solo 401k would actually serve a great solution for you, because as the single employee, you're basically the employer and employee of your business. A good example of this would be somebody who's like a truck driver. There's a lot of trucking companies established. This is a perfect solution for those individuals. You would establish this type of account because, number one, you have all this extra money you can contribute to your own retirement account, and it'll automatically deduct, it'll reduce your individual income that you have to report for tax purposes. And also, as an employer, the contributions that you make to your own retirement account can actually be deducted on your business taxes. And obviously, there's a lot of limits that you want to research and make sure, talk to your tax professional about what makes sense for you. But let's say you are an employee, you can set aside, 20,000 up to $27,000 of your income into an account for retirement. And as you can see, this limit is a lot higher than the other accounts that I had just went through. But also, as the employer, you can make what we call profit sharing contributions on your behalf into your own retirement account, and you can contribute almost double, what you contributed as an employee. So it's like you put in money as the employee and you put in money as the employer. So this will be for someone who has no full-time employees, but you do generate pretty significant revenue. And you can make these contributions either pre-tax or Roth contributions. This is a very, very great plan for those of, especially like I said, if you're the only person running your business, but you have a lot of cash flow, you make a lot of money, and you want to find some tax benefits so that you could put money away. So let's go to the next slide. This one is actually a life insurance product. Remember how I talked about you can use products from insurance companies to grow your money as well. This is actually cash value life insurance, also known as permanent life insurance. There's different types. Today, I'm really going to focus on index universal life insurance, also known as IUL. Again, I'm not recommending it. I just want to just share about it because it's a very unique strategy, leveraging life insurance to grow money. So first of all, you would have to apply and qualify for the life insurance aspect of it. It's a life insurance policy, so it's based on your health, your medical background, your life expectancy, and you would apply and qualify for some specific death benefit. And then that policy offers another feature where you can grow and accumulate cash inside the plan and you get stock market like returns. It's not invested in the stock market, it just follows the stock market. There's usually a minimum and then there's usually a cap. So let's say the minimum might be no matter what happens, you're always going to get 0.75% interest. I mean, that's way better than a lot of banks are getting. And then they might say, if the market goes up, we'll give you a credit of 15% interest. And anywhere in between how the market performs, you'll get that particular interest rate. But what I really like about this is because that money that grows inside the life insurance policy, it grows tax deferred. But once it's fully available to you and out of the surrender period, you can pull this money out at any age, at any time, for any reason. It doesn't have to be for retirement. There's no age 59 and a half requirement. I like the solution. Like I said, this is actually one of the solutions I use for myself. I actually established this for my children as well so that they can have money available to them in the future when they get, whether they choose to go to college or not, they'll have thousands of dollars built inside this plan. Another thing is that there's no income limits based on the owner. You would be the owner because it's on your life. And this is a really excellent strategy that you can use to set aside a lot of money because the IRS doesn't look at this as an investment. They pay attention to it for sure, but this is a life insurance product first. So they have higher limitations on how you can put money into this type of strategy. So let's go to the next slide as I start to wrap up here. So the one question that I always get was, Chantay, all this stuff is great. What should I pick? What accounts make sense for me? It really depends. I wanted to give you a super high level idea of what's out there, what works, how these things work. It really depends on your individual situation. Do you have employees? Do you not have employees? Are you the only person in your business? What is your income? Are you actually earning enough income where it makes sense to establish one of these type of retirement accounts? Are you married? The reason why I ask about are you married is because your spouse, they might be working for you in your business. They might not. They might still have their own job where they have access to another corporation's benefits. That matters to where how much you can put into some of these accounts. And then again, like I mentioned, I'm talking about our favorite Uncle Sam, the IRS. Do you need taxes? Do you need ways to avoid taxes and get some tax deductions. So again, sitting with a team of qualified financial professionals, whether it's a CPA, an accountant, a financial advisor like myself, we would be able to give you guidance on what makes sense. How can you maximize all of these accounts as a business owner? So the last slide is just for those if you want to have my contact information. I know that we'll continue for Q&A, but one of the resources that I offer when I do any type of presentation is to always give folks to have an opportunity to have a conversation with me, because I know I have you thinking about a lot of stuff, and you probably have a lot of questions that might not make sense to ask, or they're very personal that shouldn't probably be asked in this general setting. But have a moment. You can schedule a 30-minute consultation with me. We do it over Zoom. It's just 30 minutes just to have an unbiased, unobjective conversation to see how I can help you. I might be able to share additional resources for you to look into to help you consider some of your financial goals. And if I think I could personally help you, I'll let you know and I'll talk to you about my process and how I work with my individual clients. Otherwise, if anyone would like to stay in touch with me, you can email me here on my email address, shantay.moore@howmoneyworks.com. Every week, I send out a newsletter to all of my contacts where I send out free financial tips, resources, blog articles. I host a lot of online webinars myself, and you'll get access to that information. So if that's something that you will be interested in, just to stay in touch and hear the things that I'm constantly sharing about when it comes to this financial world, definitely email me and I'll be happy to connect with you and put you on my email newsletter list. So I'm done. I wanted to get through that pretty quickly. I know it's time for Q&A, and Kenyatta, and want to get bring you ladies back up to facilitate the rest of the conversation today.
Thank you so much, Chantay. That was a lot of valuable information. And side note, that cup is beautiful. That
Oh, thank you.
you just brought up. But anyway, back to the thing. It was a lot of great information, and I thoroughly enjoyed what you had given us. So we do have questions for you. And the first question is in, well, I guess a person, but then also a business owner. Do you suggest or recommend like a certain amount of savings before starting any type of investments?
No, I would say so. One of my tips for business owners is number one, always keep your personal money separate from your business money. But I always encourage folks to at least, at a minimum, you shouldn't be talking about investing if you don't have an emergency fund in place. And that's literally 3 to 6 months of savings established, because I don't want you to establish all these investment accounts, start putting all this money aside, and then something always comes up, especially in business. Like you have this $2,000 major expense, and then you have to sell off your investment. That defeats the whole purpose.
Right.
So that's pretty much the only thing I would say. Have a good, solid emergency fund established. Have that money, ready to help operate your business. And then whatever is extra left over, start opening the investment accounts. And it doesn't really take a lot. You can do $5 a week, $25 a month, until you can really build yourself up into saving consistent amounts over time.
That's awesome. You were talking about ETFS and then UITs.
Yes.
Where would someone go and get those? Is that so? So outside of speaking to a financial advisor, is that something a person can also get at a bank, or is that through like stocks or things like that? How you get that?
Yeah, so ETFs or UITs. So typically, to purchase into a UIT, you would need a financial advisor. Again, because we give you access to some of those things you can't get on your own. ETFs, exchange traded funds, you can actually find those. You could probably Google it and find a whole list of online investment companies that their specialty is creating ETF portfolios. Because even though I talked about like stocks, mutual funds, bonds, not every company offers those type of investments. There are some companies, and unfortunately, I can't name any particular ones, but you can literally Google it, and you'll find companies where that's all they invest in are ETFs. And those are actually my favorite. So if you're really getting into investing, ETFs are low cost. They're actually also very tax efficient. And so like mutual funds are kind of like having an old brick cell phone. Like that's how old school they are. They serve their purpose. They get the job done. ETFs are like having a smartphone. They're like the enhanced version of a mutual fund.
You were speaking about the stock market and people having their limit, or oh, if I lose $5, then I'm just like I'm over the place with it. Is there a safety net or like a way that people will know, oh, it's dropping down? This is your time to like buy out, or I mean sell or anything in stocks?
Yeah, I mean, this will really just take responsibility for someone to just stay aware of the market. You know, and that's the challenging part. Like you're a business owner, you don't have the time to look at what's going on in the market. You shouldn't. You should be focusing on your business. That's why I encourage you to work with professionals because I see those things coming. I see those things coming, and I let my clients know. But typically, it really just depends on your investments. You know, like right now, like I mentioned, in the news, what's been in the news, inflation. Inflation gives us a volatile market. And I don't necessarily suggest just because the market is going down that you sell off your investment. It's actually a great time to buy more and invest more because everything's on sale, everything costs less. You know, when I talk about a comfort zone, the market's going up and down every single day. And honestly, when you're an emotional investor or you're trying to time the market, you know, oh, let me buy at this point or let me sell at this point, you actually lose money by trying to time it or looking at the ups and downs. So a couple of things you want to do. You want to establish a strategy where you don't have to, you know, actively move in and out of accounts and out of a position. Because those could give you tax consequences. You could be, you know, having a gain and a loss on one end. It just gets complicated. The way I invest or look at folks and investing their money is to have strategies where we can ride the ups and downs. We expect the ups and downs to happen, but just because the market is down doesn't mean that I'm going to call you and say, "Hey, we need to sell out of something." But if like say if you say, you know what, I don't want to lose no more than 10% of my money, and if you see a 10% decrease in your account, then that's 100% okay to completely sell off the investment to, you know, so you don't lose 15 or 20%. So it's really individualized. Like again, what's going to make me really worry? You know, a lot of these accounts you can check your balances throughout the day. You can check them. I mean, and again, I don't encourage that. You can check it frequently if you wanted to. And if you in your mind, if you hit a percent trigger for you, if it's uncomfortable for you, then you can sell off some type of investment if it makes you feel better.
Okay. What about when you work with when a person works with a financial advisor?
Mhm.
Do they pay a monthly rate or a fee, or is the payment out of like your profits from your investments? How does that work?
Yeah, that's a really, really great question. So, some financial advisors do charge a management fee based on the balance of whatever they invest for you. So, they might say, okay, you know, Kenyatta, I'll invest your money, but I'm going to charge you 1% of the balance of your portfolio. And that's okay because they are incentivized to increase the balance of your assets because when you make money, they make money. So
Mm-hmm.
some advisors do charge in that way. Other advisors might charge like a flat fee, no matter what balance you have, no matter how many accounts or assets, it's just a flat rate. And then there's other advisors who they don't necessarily charge for a service. There might be a management fee that's automatically built into the product or the, you know, whatever that you're opening so that your money is fully invested. And then, so typically like maybe once a quarter, they might get a little bit of the money from your investment, and that's normally built into the product. So it's a couple ways that advisors can get, you know, can pay or charge you or get paid for giving that investment advice.
Okay. So you know how well, not small business only, but businesses can have like a business credit. When doing investments, can businesses have their own investment account, or do everything go under that person and that person's name?
Really great question. It just again, it depends on where you are in your business. I would say so for all these IRA accounts that I talked about, these are individual accounts. So they would actually be in your name. They can't be established. An IRA cannot be established for an entity. It can only be established for a person. But there are investment accounts and there are products that you can establish under the business name, where you would use the business's tax ID number. But it just depends on what account you open. And again, that's why I encourage folks talk to your tax professional, because they'll let you know best what would give you the most tax benefit. And you can do multiple accounts. You can do the SEP IRA. You can have a 401k. Like you can, a couple of these accounts you can overlap on top of each other. It's just really knowing what gives you the best and maximum tax benefit.
Yeah. You were speaking about the IRA account, and after age 59 and a half, you can withdraw with, and then I think it's
No
like
taxes.
no taxes.
Yes.
Are you is a person able to start one after that age, or okay?
Yeah. So with the IRAs, they actually just changed this. I think last year the rule used to be you had to be 16 or older with an income. Now you can have, as long as you have income, and again, this isn't like cash under the table, it's reported somewhere. At any age, at any income, you can establish these accounts. I know the traditional IRA used to be like if you were older than 70, you couldn't open an account. They got rid of that. So yeah, already any age, as long as you have a reportable income, you can open these accounts.
I think it the SEP or the SEP IRA. Those are the ones where a business owner will have it for their employees, right? The
Yeah.
SEP one.
So both a SEP IRA or a simple IRA can be established. They would be established for your employees. The only difference is who can contribute. Typically, with the SEP IRA, only you as the employer would contribute to that account for your employees. With a simple IRA, you can contribute as the employer, but the employees can also set aside money into those accounts.
Okay, because so I know that everything is different based on the person's wage and the company, but I'm just trying to see, is the SEP or the other one reasonable for a small business owner? Like if they had like 3 employees or 2 employees, just to kind of get an idea, like a roundabout, is that something that is obtainable for a small person, or should a person have to have X amount of dollars in order to start it?
Yeah, no, the IRS rules. And so the IRS makes up all the rules for all of these accounts. So the IRS mandates that you can establish, so there's a lot of little nuances and rules that I don't know off the top of my head, but typically no, you don't have to have a minimum, dollar amount in business or revenue. You don't also have to have a minimum amount of employees. It more so goes off of, are these employees like, I can't remember which IRA. One of the rules is they need to have made $600 within the last year, or they need to have been working with you for 3 years. So, and those aren't even strict. You can give, because these are your business accounts. Make you can also make exceptions to those rules when you open the accounts. So, your financial advisor, you can establish any of these accounts that I talked about at any time. It doesn't have to be like, oh, you need to be a well-established business or you need to have full-time employees. It just again individually depends on where you are in business. Like a simple IRA, you really need to have a good solid cash flow, because you have to contribute for everybody. You have to make sure that you can afford to could make those contributions. So it just depends on where you are as far as how financially stable you are in your business when you can establish these accounts.
When you were speaking on the solo 401ks, um, and you were saying a lot of money,
Yeah.
right? So, just for our viewers and listeners, like, what is possibly a lot of money? Meaning, is that if you make over 100,000, or is that, can that be just if you have X amount of profit left over what you make? Like, what is a lot of money, so that a person who heard it can probably say or think about if their business fits getting a solo 401k
Mhm.
versus a Roth IRA.
Yeah, so for the solo 401k, so let's just look at the limits. So contribution wise, let's say you're over 50, the most that can go into that account is $64,000 for the entire year. about half of that would be your employee contribution. And the max that you can put in as an employee is 25% of your compensation. And that's like 27,000. So it was 27,000 times four. Like, I don't know. I need my calculator. I can never do math on my head.
Let me see.
So that's $108,000 to where you can maximize your employee contribution. And then on top of that, as the employer, you can add in another, what was that? Another, it's like another 27,000, like another 30, 27, 30 something $1,000 on top of that. So, I mean, if you're adding, another 30,000, that means your business would have profited at least 138,000. So then the question is also, well, what do I get to take home as an income? Maybe that's another 50,000. So you're definitely looking over six figures for sure. At least that 108,000 to get at least your 25% contribution in, because 25% of your compensation. And then, okay, how much do I actually want to contribute above that as an employer? So I would say probably about a quarter, $125,000 income or higher. Where that would really make sense. And it doesn't mean, and the reason why I say solo 401k, it makes sense for those high earners because you can't establish a Roth at that point. You make too much. You could probably do a traditional IRA, but you can only put in $6,000, or $7,000 for the year. So the solo 401k really gives those high income earners a way to put aside a lot of money for retirement, if that's their goal, if that's their desire.
Okay.
Yeah, some really great questions.
Yes, I do have some questions as well. So when you had spoke about Chantay, the I believe it's the SEP IRA, the ones that you can put in for your employees. It was two of them.
Yes.
Can the business owner be one of the employees too?
Yes.
Or is it better to kind of keep it separate and do an individual one?
No, this would include you as the business owner as well. So again, the difference is one allows only the employer. I mean, and it's kind of funny because we're always the employer, and sometimes we're the employee, and we're the company also. So the only difference is one allows only the employer, which would be you, to contribute, and the other one allows employees to also contribute. But yeah, you would be included as well. So you would establish the SEP IRA or the simple IRA for yourself too.
Awesome, thank you. And then, of course, with a financial advisor, how do we know if people legit? Like, this is something that is serious, right? And it's like,
Yeah.
okay, I'm about to invest my money. I want to really understand. So what are some of those things that we should be looking for when making sure that we are with someone who is legit? We can come to you, but
Yeah.
if we can't get to you, how
Yeah.
do we know?
It's not for everybody, but everybody I'd love to help. So yeah, it's one of the slides I actually took out, but it's a really great question. So a couple things. Number one, if anybody is talking to you about investing or investments, they have to have what's called a securities license. And I'm trying to, and just to give you as much so you can know as a consumer and investor, a securities license is what allows us to sell investment products, to sell a stock, to sell a mutual fund, or open those type of accounts. And you can actually check if somebody has that license by going to finra.brokercheck.org. I can probably try to put it in the chat real quick. That website, you would actually be able to look up somebody's name, because this is the regulatory authority that manages us, that keeps us in line as financial advisors because we have these licenses. So FINRA, I can't even think what the acronym stands for. It's like Financial Industry something regulator something. But they're the ones who manage all the financial advisors. We have to get licensed. We all get licenses through under this organization. And you can see if somebody's legit because we would be on there. We would be shown as active. Or you can see when we received our licenses. The advisor should also be attached to some financial company as well. And you will be able to see all of that. So that's the first thing to see, because I see, unfortunately, a lot of like insurance agents, they try to talk about investing and they're only licensed to talk about insurance. They really shouldn't be talking about or giving you advice about investing if they can only talk about insurance products. So that's the first thing. Another thing I always tell folks to ask the advisor, well, how do you get paid? How do you make your money? Because as a financial advisor, we have to disclose how we get paid. And if somebody says, oh, you don't need to know how much money I make, you don't need to know what, how I get compensated, run away from them. That's a huge, huge red flag. Another thing that you can also to see if somebody's like kind of qualified or what's their level of expertise is ask them how long have they been in the industry. It doesn't mean that if somebody's been in the industry for a year isn't a great person or a great advisor, but it's up to you. What level of experience do you want? And then the last question I would always ask advisors is, well, how many financial products can you even offer me? How many companies do you work with? Because some advisors are only tied to one company and they can only offer like a handful of financial products. Some of them have a broader scope of financial products and investment accounts that they can offer. So you want to know, I mean, in my opinion, you want somebody who can give you the gamut of everything because they're not trying to put you into one little pigeonhole because that's all they can offer. So those are a couple of things that I would encourage you to, when you're seeking out advisors, interview them. You don't have to just choose someone just because they say they're advisor. Interview them. Always ask them, like, what's your investment style? What would you do? And if the market did this, how would you stay in contact with me as your client? If I have my money invested with you, what can I expect from you with you being, with you as my advisor? So hopefully those are some helpful tips.
That's awesome. Can you put that website in the chat and then I'll share it on the stream if you have time?
Okay. Yeah, I'll look it up right now.
Yes. So thank you for sharing that. And I really appreciate the part where you talked to us about just now about the interviewing process, because it's almost kind of like, oh, we just go in, but being able to ask those questions and to really find out more. So thank you.
Yeah, of course. And here's the website. I'll put that into the chat. So get their name, what state are they in? What company do they represent? And depending on what licenses they have, we actually have to give you a brochure that talks about our qualifications, that talks about our background. So there's a lot of protections to protect the investor and the consumers, because you don't want to be involved in a Ponzi scheme and somebody takes your money.
Absolutely not.
So this is the website she was talking about, brokercheck.finra.org.
Yeah.
Brokercheck.finra.org to see if the people are legit.
Yeah, if they're registered, if they have licenses, you can see if people had complaints against them, because we have to disclose this stuff every year. If we have bankruptcies, if people file complaints against us, like, we work in a very highly regulated industry, and we should. We know we deal with your money. We want to be responsible. We want to be held responsible if something goes wrong.
Okay. Well, we definitely thank you, Chantay, for being with us on this live on our third day of our 3-day financial workshop series about money. We have gotten a lot of valuable information from you. For those of you who are watching us live and who are watching the replay, you can get in contact with Chantay at www.nafls.com, as well as she has a book, right?
Mm-hmm.
Yeah, that's the one.
Yes.
At this website here, howmoneyworks.com/Chantay W Moore/book. As well as she is offering a free 30-minute consultation for anyone who needs more information about anything that she covered today. And that link is bit.ly/talk-to-Chantay. So we definitely appreciate your time. And if you guys have any questions, please put it in the comment section. And you can definitely watch the replay over and over again. Definitely make sure you take your time and then come back to this same station, Facebook channel, at 1 p.m. We will be having our next session at 1 p.m. live today. So we hope that you have enjoyed it, and please make sure that you are doing our 4-question survey, which is in our comment section. If you would like more information or more content from Colorboat, please fill that out for us. So thank you guys, and thank you again, Chantay. We thoroughly enjoyed it.
Yes, thank you for having me, and have a great rest of the session.
Thank you.
Thank you.